Marcus was 27, just got his first real paycheck, and was finally ready to invest. He opened a brokerage account, searched for index funds, and immediately got stuck. Two options kept coming up: a total stock market index fund and an S&P 500 fund. They looked almost identical. Same low fees, similar returns, thousands of five-star reviews. So he did what most people do. He froze. Today, we're going to unstick Marcus and anyone else who's been in that exact spot. By the end of this video, you'll know exactly what makes these two funds different and how to decide which one belongs in your portfolio. Let's start with the S&P 500 because it's the one most people have heard of. It tracks 500 of the largest publicly traded companies in the United States. Think Apple, Microsoft, Amazon, Berkshire Hathaway. These companies are selected by a committee at S&P Global, and they're weighted by market capitalization, meaning the bigger the company, the bigger its slice of the fund. Together, these 500 companies represent roughly 80% of the total value of the entire U.S. stock market. So when you hear the market was up today, they're usually talking about the S&P 500. This is the benchmark most professional fund managers are trying to beat, and historically, most of them fail. Now here's where Marcus had his first aha moment. The total stock market index doesn't just hold 500 companies, it holds over 3,500. It captures large cap companies, yes, but also mid-cap and small-cap stocks. These are the medium and smaller businesses that don't qualify for the S&P 500 yet. Think of it this way. If the S&P 500 is the varsity team, the total market fund includes the entire school, varsity, junior varsity, and the freshmen with huge upside potential. Because it's still market cap weighted, the largest companies still dominate, but you get exposure to a broader slice of American business, including tomorrow's potential giants before they become household names. This is the chart that made Marcus take a deep breath and relax. When you plot the S&P 500 against the total stock market index over the last 20 years, the lines are almost on top of each other. We're talking about a difference of less than 0.5% per year on average, according to historical return data. Both funds suffered in 2008. Both bounced back. Both hit new highs. The reason they track so closely is simple. The S&P 500 makes up about 80% of the total market fund by weight. So the big companies drive both funds in almost the same direction. This doesn't mean they're identical, but it does mean you're not making a catastrophic mistake either way. So if they're so similar, why does the choice matter at all? Here's the real difference. The total stock market fund gives you exposure to small cap and mid cap companies, and historically, smaller companies have tended to outperform large caps over very long periods. This is sometimes called the small cap premium, but with higher potential reward comes slightly higher volatility. Small cap stocks can swing more dramatically in downturns. The S&P 500, by focusing only on large established companies, tends to be slightly more stable. Marcus realized this was actually a question about his personal risk tolerance. Was he comfortable with a bit more turbulence in exchange for slightly broader exposure? That's the real trade-off here. Let's look at the data behind the small cap premium. This bar chart shows the average annualized returns of large cap, mid cap, and small cap U.S. stocks over the last 30 years, based on historical index data. You can see that small caps have historically delivered higher returns, but the gap isn't dramatic, and it comes with significantly more volatility along the way. There were entire decades, like the 2010s, where large caps dominated. The small cap premium is real but inconsistent. For Marcus, who had a 35-plus-year investing horizon, some exposure to small caps through a total market fund made sense, but it's not a guaranteed edge. This is for educational purposes only. All investments carry risk. Here's a number Marcus didn't expect: 0.01%. That's the difference in expense ratios between Vanguard's total stock market ETF, ticker VTI, and Vanguard's S&P 500 ETF, ticker VOO. VTI charges 0% per year. VOO charges 0.2% as well. Many equivalent funds like Fidelity's FZROX charge literally zero. The cost argument, which used to favor one fund over the other, has essentially disappeared. This is a massive win for everyday investors. You're not giving up meaningful returns to fees either way. So Marcus crossed cost off his list of decision factors entirely. The real decision comes down to philosophy, and we'll get to that. So which one should you actually pick? Marcus eventually landed on this framework, and it's a good one. If you have a long investing horizon, 20, 30, 40 years, the slightly broader diversification of the total market fund could give you a small edge through small cap exposure. But if you value simplicity, wide recognition, and investing in the most proven large companies in America, the S&P 500 is an excellent choice. The honest truth? Both funds have historically beaten the vast majority of actively managed mutual funds over 15-year periods, according to S&P's SPIVA report. The bigger mistake isn't picking the wrong index fund. It's not investing at all, or bailing during market downturns. Pick one, stay consistent, and let time do the heavy lifting. Let's make this concrete. For the S&P 500, popular options include Vanguard's VOO, iShares IVV, Fidelity's FXAIX, and SPDR's SPLG. For the total stock market, there's Vanguard's VTI, iShares ITOT, Fidelity's FZROX, which has a 0% expense ratio, and Schwab's SWTSX. All of these funds have expense ratios under 0.05% annually. Many are available directly inside your 401k or IRA. Marcus found FXAIX already sitting in his company's 401k plan, so he started there. The best fund is often the one your plan already offers at the lowest cost. Don't overthink the brand. Focus on the index it tracks and the fee it charges. Here's the number that put everything in perspective for Marcus. If he invested just $400 a month, about $13 a day, into either of these index funds for 30 years, and the market delivered its historical average return of roughly 10% annually, he'd end up with approximately $487,000. That's based on standard compound growth calculations. And remember, the difference between the S&P 500 and total market over those 30 years? Historically, less than 0.5% annually. The fund you pick matters far less than whether you actually invest, how consistently you contribute, and whether you stay invested during market downturns. Marcus chose VTI and set up a $400 automatic monthly transfer. Done. Marcus spent 3 weeks paralyzed by this decision. After doing the research, he realized the choice wasn't nearly as dramatic as he thought. Today, he automatically invests $400 a month into VTI inside his Roth IRA, and another chunk goes into FXAIX inside his work 401k. He stopped trying to pick perfectly and started picking consistently. Here are the 4 things to remember. The S&P 500 tracks the 500 largest U.S. companies and is slightly more stable. The total market adds small and mid-cap exposure for broader diversification. Their long-term returns are remarkably similar. And the most important factor of all is staying invested and contributing regularly, regardless of which fund you choose. Subscribe to US Wealth Logic for more content like this every week. Everything in this video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results,